Cloud. Go.
Welcome everyone to this session of Capital Introduction Summit. Thanks to Smart Money Match for inviting Tuning Bill. So my name is Mohan and I'll be interviewing Asit Beesen, the founder and CEO of Tuning Bill. We have an exciting topic for today. It is disrupting supply chain finance through neobanking. So we'll straight jump into it. Asit, welcome. You say neobanking and supply chain finance as the theme. Could you elaborate for the audience, please? What exactly does that mean, and what's the connection there?
Great. Thanks, Mohan. Thanks for this interview, and thanks to the organizers. The idea of merging neobanking and supply chain comes as follows. So all of us are aware of, especially and we are into global supply chain, by the way. So into the global supply chain finance, we know there are several challenges. And the challenges are real in the sense that we know that two counterparties who trade with each other, when they do import-export, they are into two different geographies, they are into two different regulatory environment. There are constraints and rules about how they do bankings into each region. And hence they have to deal with various challenges or friction when it comes to executing a trade. The trades they deserve to be managed in a much better way, like a domestic trade is, which is much smoother nowadays. In the case of cross-border supply chain, that's not the scenario. And neobanking, as we know, has been into existence for last 5, 7, 8 years. We know that it has actually massively enhanced the trading, smoothened the trading processes into the domestic market. Nevertheless, it has never taken hold of, or not yet at least, in the cross-border market. And that's where we come into. We are the first platform which is creating a uniform layer, so something that sits at the top, and it's a global platform and allows to consume the neobanking phenomenon into each geography and provide a uniform, seamless structure for traders across the borders into two different geographies to come to a platform, do their banking in an uniform way, and trade with counterparties as if they're trading domestically, as if there is no difference between whether I am selling goods to my local customer or buying goods from a local seller compared to doing the same trade internationally. So that's the idea.
Great. So in essence, what you're saying is that you want to break all the barriers, remove all the friction points using technology.
Yes.
And then, of course, you also add all of the banking and FX elements so that the supply chain community can carry out their trades more efficiently and seamlessly and almost real time. Is that
That's right, Mohan. So if you think of it, when two entities trade with each other, what's happening? It's a barter. There is money involved, and you sell goods, and you receive money. Now, because the two entities are into two different geographies, there is a payment process involved. There is a change in the type of the currency also involved, because two entities their local currencies will be different. And hence, we know that the trading requires cross-border transactions, FX, etc. And then there are various regulations around money laundering, compliance, etc., like why the money is crossing the border from one country to another. Those things have always been hassle. They're still a hassle. Every trader has to go through various hoops and loops to send the money to their supplier. The supplier has to go through hoops and loops to receive the money and realize it into their bank account when they receive money from abroad. For example, an exporter in an emerging market, when they receive money from their importer, they have to submit hundreds of papers to their bank. Now, that's not going to change, but the problem with these kind of regulations is they cannot receive money from somebody else for that trade. So let's say there's an exporter sitting in China or India selling goods to somebody in US, and the importer manages to finance that trade. It's not that straightforward that the financer sends the money to the exporter.
Right.
There are various complexities involved there.
Process. Yeah, it's a completely separate process.
Completely separate process. However, what we have done is using neobanking or digital banking, we have smoothened that process, and using technologies, we have removed some of the regulatory hurdles into those money movement. And at the same time, we provide much better FX rate, much cheaper transactional costs for us because everything is digital and everything is smooth in terms of how we operate.
Okay, got it, got it. Okay, so in essence, so you picked a specific space for launching the neo banking technology,
Yes.
not like all SMEs, not like any business. So you do have a specific focus area focused on international trade, which is always interesting, I think, because I think in the last few years we have seen time and again some of the neo banks not able to make the model work, right? So have you seen that happening, or how is the traction here? Or because you have a specific segment focus, do you think you are able to do better than them?
That's actually an excellent point. Basically, if you look at the evolution of neobanking, they have been pretty strong and successful in domestic markets.
Mhm.
You pick one country, one geography, you are regulated by one entity, regulator, and you manage to expand it and sell it in the local market. And despite we can count 5, 6, 7 successful neobanking entities in the market right now, none of them have actually ventured into executing it cross-border in the way we are doing. So we are, in a way, the first platform who is catering to two customers from two different geographies at the same time on the same platform. So what we are doing is we are providing two counterparties from two different geographies an ability to onboard. I go through the KYC, KYB processes and opening bank accounts in a very standard format. All of them go through the same experience, whether you are an Indian exporter or an American importer or an European importer, all of you go through the same process. And even though the providers of these processes for us are different into different geographies, we are providing them through a standardized process. And that suddenly opens kind of various doors of makes the execution much more interesting and simplifies the whole process, as I said. And that's where our I think our edge is. We are getting good tractions because the first time from the transactional perspective, customers can feel that they are working with the same bank in a way, or banking entity, even though we are not bank. So from neo-banking perspective, they can feel that they're working with the same entity, whether it is the exporter or the importer. And that's the breakthrough here.
For the benefit of audience, I mean, you raised an important point there. So you are not directly regulated, right? So
That's right, yes.
how does this whole thing work? And does the, what should the customer know about it, or or how, if you can share a bit, yeah.
See, from practicality perspective, the customer should be agnostic about it. However, from the contractual and regulatory perspective, of course, they know and that, okay, the exporter sitting in India is getting the bank account through a local entity that is again managed by Tuningville, right? However, they come on the Tuningville platform. The ecosystem is Tuningville, and the dashboard, the processes, etc., are built that are specific to this kind of business. It's not about it's not a generic system, if you know what I mean. The same thing happens with the importer, for example. They will contractually, they know that they're getting a bank account through a local entity, but again, they land into the ecosystem of Tuningville. So the banking licenses are into their respective geography, and we are aggregating providers into various geographies and accumulating them to plug in into the uniform outer layer.
So in a way, the whole transaction can be done on one platform,
Yes.
irrespective of which bank is behind in which region. So as far as the exporter and importer and trader are concerned, they are just kind of doing the transaction on your system. Everything happens automatically behind the scene, and all of the regulatory plumbing is behind the scene. So that's quite efficient and smooth in a way, right? So it's a much better user experience, I guess.
Exactly. So that's one thing. And then if you look at from the transaction perspective, cross-border transactions are always shrouded into like, okay, what's happening where the goods are coming, where the money is going, et cetera, et cetera. Now, all of it is at least on one platform. So even though various entities are involved, not only banking, let's say the shippers, the the forwarders, etc. All those information are at one place.
Right.
And that brings us about to discuss about the data part of it. Like, okay, so we have the visibility of data, who is trading with whom, what are they trading, at what prices they're trading. All those things suddenly become transparent, and especially in this SME market, that has got value, and that's where the value for an investor comes from. And
I
we are
see.
talking about both the capital into tuning bill as well as the funders of the trade, if these guys are doing, and if we manage to fund their trades, all those transactional information make the ability to capitalize these transactions much easier and smoother, and I'll say cheaper in a way as well,
Yeah,
because the
that's
transparency.
good to know, because I think people may not pick it up on the on the face of it,
Yeah.
and because this is a long-term data play around SMEs and global supply chains, right? And
Yes,
which is
exactly.
really powerful. First of all, this is a global play, and the way you have integrated banking and the traditional supply chain finance or trade finance industry is rather probably for the first time somebody has done it, because I am familiar with few other fintechs who are trying to break into disrupt this industry quite a bit as the banks are receding through technology, but most of them rely on just financing, but typically through invoice discounting or factoring, particularly on the exporter side. So how does your model different? So apart from also obviously giving the banking services and making them integrated into the whole process, so can you talk a bit about the financing product and how is it different from the other alternative fintechs that are trying to do something similar?
Yeah, sure. So, I mean, we have heard various stories during this COVID time where things have gone wrong, especially into the discounting and factoring model. And we realized quite early that there has to be a new model where the trust comes into picture and is much more valuable, in the sense that we know that this trade can be funded, which and is trustworthy, and the transactions once executed, the money will come back, will be paid back, and so and so. So we actually moved away from, not away from, we never went into discounting and factoring model of, I mean, people who understand the cross-border trade finance, they will understand what we're talking about. We went through the loan program. In the sense, what I mean is, we never fund a trade on the receiver side. We always fund trade on the payer side, and we fund a trade on the book of the payer. So if there's an importer, the process will still be equally seamless, in the sense, if a trade has to be financed, there's an exporter sitting on one side, there's an importer sitting on the other side, there's a trade between them, and that trade needs to be financed. We make it so smooth in the sense that the money always is lent to the importer, who then pays to the exporter. And the platform and the technology takes care of that, in the sense that it solves various regulatory hurdles as well. There can be an investor sitting in America now, will still be able to fund an importer sitting in, let's say, Germany, and the goods are coming from India. Earlier, without this technology, it was not possible, because the exporter will have to go through various hassles to receive the fund from a funder in America for a trade that is being done between a German importer and an Indian exporter, not through our platform. Why? Because we are structuring it as a loan to the German importer, and the German importer, through our platform, will seamlessly receive funds from the American investor, and the money will be automatically transferred to the exporter. The exporter will see the money coming from the importer, and voila, the whole process is, and the regulatory angle is just sorted. I mean, there is no complexity around it. It's a very simple,
I mean,
simple model.
one is the regulatory aspect, but I also see that you may be a lot efficient operation as well, because you're just focused on the Western developed markets where you are offering loans to the importers. So that means you don't have to have a large sales force in emerging markets or exporting markets.
That's exactly correct. Yeah.
And then you don't have to rely on them as the counterparty, primary counterparty, or in terms of KYC and all of that. So you have in a way reduce the whole complexity quite a bit in terms of by focusing on the importer and actually do and directly going to them, because in a way whether they do export the receivable discounting or loans to the importers, the real counterparty is always the importer. The importer has to pay the money back after the 120-day credit period, right? So in a
That's
way,
right.
you made it efficient. You are going direct, and it's a loan, so that means it's recoverable as well. What kind of security do you have on these clients when they
Right.
take the money from you?
So we take full security in the sense that we are taking a charge on the importers. And you're right. So one of the important aspect is because we are lending to importers in the developed market, and no matter how much we talk about this, there is no denying that the legals are much stringent and much stronger into the developed market. So if we are lending to a developed market importer, SMEs, the recovery chances are far higher compared to lending to an exporter, and especially if you are a funder in a developed market. Plus, the availability of fund is also cheaper in the importing market.
So it's on balance sheet. It's not off
It's on
balance
the it's
sheet.
on
It's
it's
not
on the
invoiced.
balance sheet with full charge. We take the security, and we look at the cash flow and the balance sheet of the customers. They start doing banking with us, in the sense they start using the bank account we open for them. And we have some other program as well. So this is in fact the less secured model, where we fund, let's say, 70% of a trade, right? And that 70% funding itself is further structured. I mean, this is not the right forum to go into that. Maybe that's too much of detail. But let's say there's $100,000 a container being financed. $30,000 is being financed by the importer. $70,000 is financed by our investor. So
Okay.
there is already a very low leverage. They pay their shipping costs, they pay the taxes, etc. So we are very well secured, and we take the first charge on their assets, their bank accounts, where they receive their local goods sales proceeds, etc., etc. So that's the that's, I will say, is the less secure model. And we also have an ultra secured model, where we actually have a master importer concept, where if we are unable to take charge on a customer, either because the customer is just too small, we
I see.
don't think that if they go bust, we may lose even there, or if they already have a large bank line item, bank credit line. In that case, what we say is, okay, we have a master importer who has free credit line with us, and that master importer can actually import on your behalf. The goods will stay in our warehouse, and the goods come here, we finance it, and you do pay as you go once the goods have come here. So it's we call it fulfillment by Amazon equivalent, but in a B2B market, the goods come here and the goods stay in our warehouse. Same model, the importer would have financed 30%, but we could not finance them on their book. We could not give them a credit line, so we finance the trade, the goods are with us. And as and when they sell into their e-commerce market, either on Amazon or eBay and all, they take the goods from us, they pay us. It's as simple as that.
Right, right. Okay. So I mean, I can see that this is getting quite involved on the customer side in terms of their operations, etc. And with neobanking as a nice, neat enabler to all of this process, and trying to make everything simpler and more efficient and faster. So definitely, as a concept and as an idea, very interesting. And just going back to the neo banking side a bit, like what does the customer get? Say importer in UK, right? So
Yeah.
he contacts Tuning Bill. What does he get? And why should he work with Tuning Bill in a way? And what is it that he doesn't get from a bank that just does financing or opens a bank account, or from a similar fintech which is trying to offer financing but without any concept of neobanking or enhanced security or even fulfillment and all of the trade related services that you mentioned?
Right. So obviously, we first of all, Tuning Bill is the neobank only for importers and exporters. So the processes, the dashboard, the flow, etc., actually built specifically for global importers and exporters. That's the first thing. If you go to, let's say, an HSBC or Barclays or any other large banks dashboard, they are very generic. I mean, they are same for everybody, whether you are a software company or you're importing, let's say, textiles to sell on Amazon. You don't see a difference. So we are specific to them. That's the basic thing, and that's about the platform. But what we are doing is we are providing multi-currency bank accounts to our customers. So an European customer will have a dollar bank account. We provide them FX services where they can actually do on the fly, much more competitive FX locking. They can convert their pound to dollar, euro to dollar, other way around. They can do their hedging, etc. So these things are super efficient for them, and they're much cheaper for them. They have the idea about their cash flow. They can have a much better view of what's going on in terms of their trade flow. And because they are trading on our platform and they are doing all these trade executions, they have much better idea, and they get all the tools to manage their cash flow and finances using our new banking platform. And then, of course, the financing bit.
Even their business, right? So because some of the operations the data is being captured on your system.
The data is being captured, and of course, the financing side, because we are so much driven by the transactional side of the trade and less by the balance sheet. Because remember, these guys are mostly traders; they don't have very big asset base. And since we are funding them based on their transactional history, and these guys are much more nimble. They know what is selling; that's what they order. And if things don't work out, they quickly move to slightly different trade line, etc., etc. So we are catering to a customer base who is very nimble into what they're buying, what they're selling. They are not into the basic manufacturing risk stage of the trade. The goods are already actually manufactured and on the ship by the time we fund them. So these are some of the nuances that we have managed to capture. And this is one of the biggest, as you know, almost 1.5 trillion, 2 trillion worth of the trades happening globally being done by these traders that go unfinanced. And we are tapping into that because technically and unfortunately, the current regulatory regime doesn't allow traditional banks to be able to support these guys.
So just a couple of questions more. So one is that we all know that e-commerce has been on the rise for last 10, 20 years, but particularly during COVID, it has gone through the roof. But we are still surprised that the infrastructure is not ready for that. There's a lot of missing pieces of the puzzle, and there are a lot of Indian exporters or Asian exporters who would like to sell to major Western retailers or e-commerce sellers. They still don't have certain operational services. And you have mentioned briefly about fulfillment before, and if you can touch upon that, and as to how this helps, particularly the e-commerce trades, where most of the banks or other fintechs are completely not wanting to serve those customers, mainly because of the lack of a real importer on this side, on the Western side of the market. So if you can touch upon it.
That's right. So this is actually a very interesting point. So what's happening is there has been a surge into e-commerce trade globally. And unlike many other businesses where financing is an angle into supply chain finance, we saw a much better performance from our customers and an increase in demand for financing more and more of the trades, because everything started selling on the internet compared to the mom and pop shops. So now, because the goods can be sold directly on eBay and Amazon, and a seller sitting in China, India, Thailand, Malaysia, anywhere can actually do those trades, they need various kind of supports in terms of, okay, who is my counterparty? And if there's no counterparty, who is going to pay me for the goods that I sell? Now, everybody will not be able to and is not able to do a deal directly or a contract directly with Amazon, for example. And even then, Amazon has a trade cycle of 30, 45, 60 days that are quite expensive. We come into picture over there where we act as a counterparty, or we are able to execute financing of these trades despite these exporters or these e-commerce traders trading into a foreign country, because we have the access to plumb or ability to plumb into finance their trades that come to the developed market, plumb into the e-commerce websites, and manage the payments in the sense that we fund the trade and the receivables come to their bank account that we have opened for these customers with us. And suddenly, because of the transactional visibility, these things are doable, unlike with a traditional bank. And we are nimble. We built the product much faster. It was very quick for us to build this product. Unlike, again, you can imagine that it's not possible into traditional system.
No, I'm quickly figuring it out that neobank is just a piece of the whole thing.
Yes,
but there is a much broader picture and a much broader value proposition for.
it's an enabler. It's an enabler. We realized very quickly. We realized very quickly that neobanking is something that can actually solve many of these problems, like opening a dollar bank account, where a trader into China is able to receive funds from Amazon, and because it's on our platform, we are able to finance their trades. Is a big deal, right? And especially when the financing can be done in the developed market where the funding cost is much lower.
Okay, great. So, and how, what stage are you in at the moment? What's been the traction so far in terms of the growth? And also, because this is a capital introduction summit, if you would like to say something about if you are if there are any fundraising events going on, or what the plan for next 2 years is, that will be interesting. Yeah.
Right. So we just finished our product, and we launched the product around, I would say, 3 to 6 months ago. Until then, we had been piloting with a few set of customers, and we have traded almost around $2.5 million worth of trades, which equates to roughly 250 containers, I would say, with exporters from China, India, Bangladesh, Sri Lanka, Turkey, etc. Goods being sold into UK, US so far. So we have perfected the model now. We have tested various scenarios, and the products are pretty much standardized. That this is what you get, whether you are an importer who is taking a loan on your book, or whether you're an exporter selling on the e-commerce website, or you are just using our fulfillment services. In terms of like what are the 3 key products, if you mean. We have already standardized our investment product in the sense that how the investment product is structured and how these trades are financed when it comes to the lending and asset management side of our business. In terms of establishing our relationship with the underlying regulatory entity, we have already established that into Europe. We can trade any trader in Europe, America, and even in some part of the Asia is able to onboard and trade through us on our platform. So all these technological aspects have been done. Our KYC, KYBs of the world class. We are, for example, just to give a name, we are using Onfido for the KYC, KYB processes. We have got Credit Bureau linked for global SME review, etc. And there are many other. We are talking about at least 15 to 20 partners that we are connected to enable our trade appreciation process, like what's exactly going on. So that's where our product is. So now what we are doing is we are launching, or we are we have set up our sales and marketing department, and we are in the process of launching our product into the wider market, for which we are raising our, you can say, pre-series A or series A, $4 to $6 million of equity raise, so that we can go in the market and go big bang and start selling the product.
Great. I mean, I guess there is a lot to do for the next few years. I think hopefully some investors on this summit are listening to you and they like the idea as to what you're doing. So overall, very interesting conversation. And if I were to start a trading firm today, or in a small importer firm today, or if there are small importer firms out there which want to grow using technology and using capital, this would be a great opportunity, I guess, and they should jump onto your platform. So thanks a lot for taking the time out and joining this summit. And I thoroughly enjoyed the conversation. So hopefully the audience do as well. And thank you. Thank you,
Thank,
everybody.
thank you very much, Mohan, and I really appreciate it. Thank you very much.
Thank you.
Thanks.
Thank you so
Bye.
much. Bye-bye.